Hello everyone, what is going on? This is Tract Mind. My name is Huey, and I am an options trader for almost 3 years now, and a stock trader for over 5. I'm here today with my very first video talking about concepts in options trading for those who are just starting out. My goal today is to keep it super simple for you guys, so let's get started. So I'm going to start with the most obvious and basic question that viewers are wanting to know. What is an option? Option is a contract to buy or sell a stock at a certain price by a specific expiration date. So one contract is equal to 100 shares in the stock market. There are actually two types of options: call and put options. Calls are bullish, which indicate that the trader thinks that the price is going to go higher. And puts are bearish, which indicate that the trader thinks the price will go down. Now, what is a premium price? So the premium price is the price the options contract is being sold for. So in this case, we have bid versus ask spreads. And what a bid spread is the price a buyer is bidding for a contract. This is the price at which a buyer is looking to purchase a contract versus the ask price. What the ask price is the price a seller is selling their contract for, which is why it's called the ask price. Kind of similar to like an auction. If you think about an auction, they have a asking price, and that is the person who is selling. They are putting their specific item up for sale for an asking price that they're looking for people to participate in. And it's the exact same thing as this concept here. In our example here, we have a bid price of 62 and an ask price of 65. The next concept is a strike price. So a strike price is pretty important when it comes to options trading. A strike price is the number you bet your specific stock price will be at by the expiration date. This can also be known as a target price. And so with the strike price, this also goes hand in hand with ITM, which is in the money, and OTM, which is out of the money. What in the money means for a strike price, it is basically a strike price below the current stock's price, meaning that stocks' strike prices have already hit. Therefore, the concept being in the money. For that reason, in the money options contracts are more expensive, but they're also lucrative and less risky, especially if the price keeps ascending. Now I'm going to talk about out of the money as a strike price. Out of the money is a strike price above and furthest away from the current stock's price. Because of this, you'll find that these strike prices and contracts actually have a lower premium price. The next two concepts I want to talk about are some of my favorite. And those concepts are delta and thetas. So let's start with delta. Delta measures profit in an options contract. And how it does this is per every dollar move a stock makes. Based on my example here for ZOM, this has a delta of 0.38 decimal. So what you do is you move your decimal 2 points to the right, and that's how much dollars your contract goes up per $1 that the stock goes up. So here we are using the strike price of 110, and if your stock goes up to 111, let's say, that would be a $38 profit. My next concept is theta, which is time decay. So theta is the amount that a contract price is expected to decrease every day until the expiration date. And this is written with a minus sign. In this example, the theta is minus 12. Same way of delta, you would move the decimal points 2 to the right, and that would be $12 that you would lose every time the stock price plummets by $1. Just one other thing to note, Call options actually have positive delta values and put options have negative delta values. So that's all for today's video. I want to notify that there will be a second video for the more advanced terms that I haven't gotten to today. So look out for that. And I just want to thank you guys so much for joining me on my very first video. Please feel free to like, comment, and subscribe. This is One Tract Mind reminding you to take it one step at a time, one contract at a time. All right, I'm out. Peace.